What's up guys, Luis here with Leal Insurance Services. And I wonder, have you ever noticed that some contractors level up a lot faster than others? They start landing bigger commercial jobs, working with larger general contractors, or getting access to larger projects that you don't normally hear about. Meanwhile, many other contractors, maybe even including yourself, stay stuck chasing the same small jobs year after year. And honestly, a lot of it has nothing to do with your skill. It comes down to this: their insurance and bonding setup. Because once you start getting into bigger jobs in Texas, your paperwork matters, your insurance matters, your bonding matters. And if your setup isn't right, you can get eliminated before you even have a serious shot. So what I want to do is break down in this video what general contractors are looking for, why cheap insurance can quietly hurt your business growth, how bonding capacity works, and what contractors can do to position themselves for the larger commercial jobs. And trust me, this stuff matters way more than you think. All right, let's jump in. We're going to start with general liability. A lot of contractors think, as long as I'm covered, as long as I'm insured, I'm good. That's not exactly how that works. When a larger general contractor or project owner reviews subcontractors, they're not just checking to see if you have insurance, they're looking for the quality of your entire setup. They look for things like your limits, your endorsements, your work comp situation, your umbrella coverage. All of that starts to get scrutinized. For example, you have a small residential remodel that might only require basic general liability insurance. But larger commercial projects, you might suddenly see requirements like 1 million per occurrence, 2 million general aggregate, additional insured wording, waiver of subrogation, primary non-contributory wording, workers' comp requirements, commercial auto requirements, and even maybe up to a $5 million umbrella coverage. And if your policy can't meet those requirements, you may not even qualify to bid. That's the part that contractors don't always see coming. I've seen contractors way more times than not lose out on opportunities just because they don't have the right coverage in place, or because their policy excludes the type of work that they're looking to bid on, or because they had limits that were too low, or maybe because their carrier wasn't accepted by the project owner. The last one surprises people sometimes. But certain general contractors and project owners absolutely care about those details. Because quite frankly, they want financial security that in the event of a claim, that the carrier is gonna respond. Now look, I understand wanting to save money. Everybody does. But even cheap insurance can become very expensive very fast because it blocks business growth. And I see this happen all the time. A contractor buys a cheap policy online, then 6 months later, they're trying to qualify for a bigger job. And suddenly they realize that the policy doesn't fit the job. Maybe the classification was wrong. Maybe the operations were excluded. Maybe the limits are too low. Maybe there's no umbrella coverage, no auto coverage, no work comp coverage. Maybe the policy was built for a handyman type of work instead of a remodeling contractor type of work. And so now they either can't qualify for the job, or they're scrambling last minute to try and find a policy that will fit the project. That's not a position that any business owner should be in. The contractors who grow the fastest usually build their insurance before they need it, not after. Because once opportunities start showing up, you want to already be in a position to be able to take them on. And another thing, general contractors talk, property managers talk, project owners talk. Your reputation matters. If your paperwork constantly creates issues, that becomes a part of your reputation too. Now, let's move on to bonding capacity, because this confuses a lot of contractors as well. Here's the simplest explanation. Bonding capacity is the surety company asking, how much work can we realistically expect that this contractor will be able to handle? That's it. It's not just about whether you can do the work. It's whether or not the surety believes you can operationally and financially survive the work. For example, you may be a great contractor, but if your business has only ever handled $50,000 jobs, the surety company isn't automatically going to give you approval for a $5 million contract bond. They want to see progression. They want to see stability. They want to see organization. And remember, a bond is different than insurance. Insurance transfers risk. The bond is more like a guarantee. If the surety pays out on a valid claim, they can come back to you as a contractor for reimbursement. That's why underwriting gets more serious. Now, you might be asking yourself, what increases bond capacity? Well, a few major things. First, financials. And no, this doesn't mean that your books have to be perfect, but organized financials matter. Profit and loss statements, balance sheets, clean bookkeeping, job costing, cash flow visibility. A contractor who has organized financial records immediately looks more professional and lower risk. Second, experience. Sureties want to see that you've had successes completing similar jobs. That doesn't necessarily mean that you need 20 years of experience. They do want to see a track record of completed projects and steady growth. Third, profitability. If your jobs are consistently losing money, that becomes a problem because the surety starts to wonder if the business is financially stable enough to be able to complete the work. Fourth, organization. Honestly, this matters more than people think. Contractors who respond quickly, provide documentation fast, communicate clearly, and run organized operations usually have an easier time growing their bonding relationships. And fifth, risk management. This includes things like safety procedures, employee training, contract review, subcontractor management, certificate tracking, and making sure that uninsured subcontractors aren't creating exposure. All of that tells the surety this contractor takes his business seriously. Now, let's talk about why contractors get denied or hit roadblocks. Because sometimes it's not one giant issue. It's a bunch of smaller warning signs stacking up together. One huge issue, poor bookkeeping. And look, I'm not saying that every contractor needs to become a CPA, but messy financials create problems. And if nobody can clearly understand the health of your business, that makes underwriting nervous. Another big one, loss history. Too many claims, especially preventable claims, can absolutely impact your ability to find insurance and bonding capacity. Weak contracts are another issue. A lot of contractors sign agreements without really understanding what liabilities they're accepting. And some contractors shift major responsibility to subcontractors. Uninsured subcontractors, that's a whole nother problem. Because quite frankly, if your subs aren't properly protected, who do you think is going to be on the hook for that? You. And yes, credit can matter too, especially with bonds. Because from a surety's perspective, your credit can reflect the overall financial stability of a contractor. It's not the only factor, but it's definitely a part of the conversation. All right, the contractors landing bigger jobs usually stop looking at their insurance as a bill and start looking at it like infrastructure. Because eventually your insurance program becomes part of your sales process, part of your credibility, part of your growth strategy. A strong contractor risk package may include things like general liability, work comp coverage, commercial auto, umbrella coverage, surety bonds, cyber liability, and even EPLI coverage if you have employees. And before you say cyber liability for contractors, absolutely. No doubt about it. If you collect any customer's information, use an online payment platform, store contracts digitally, use email heavily, wire money, hold data or plans from a contract. Same thing with EPLI coverage. Once businesses start growing and hiring, employment-related claims become a real risk too. The goal is building a support system that helps with growth instead of limiting it. If you're trying to qualify for larger commercial jobs in Texas, don't wait until the general contractor rejects your contractor package. The contractors who usually grow the fastest are the ones who treat insurance and bonding strategically, not just something they buy because they have to. Because better projects usually come with higher expectations. And being properly positioned before you get to the table can absolutely help in that scenario. If you've got questions about your current setup or you want somebody to review your current insurance program or bonding capacity to ensure that it actually supports the jobs that you want to go after, give us a call here at Leal Insurance Services. We'll walk you through it in plain English. And if this video has helped you out at all, make sure to like, subscribe, and follow our page. Or share it with another contractor who's trying to level up their business just like you. Because a lot of good contractors are losing out on good opportunities, even without realizing that their insurance is the reason why.